Good morning, dear students. Very good morning, everyone. I welcome you all to this live interactive session on security valuation, which is a part of the topic or the subject of advanced financial management, which is paper 2 of our CA final. Till now, we have done quite a few topics, which include the advanced capital budgeting, security analysis, and initial aspects of risk management and everything. Now we are just going to take it ahead with we're just going to take it ahead with the simple part of security evaluation, which is a sort of extension of a combined effect of cost of capital at CA interlevel, and then also some sort of capital budgeting part. Okay, so we are simply in the process of evaluating that part. Okay, so security valuation, first up, what's the whole purpose of carrying out this security valuation? Okay, so we are simply going to carry out this security valuation topic. So let's first understand what's the purpose of carrying out the security valuation, or what is the reason that we are having this subject in our syllabus. Now, the simple way of understanding is that the hardcore of any finance topic, there's the any aspect of topic in finance, it's going to be more of about valuation itself. Okay, so when we talk of valuation, what's the whole purpose of carrying out valuation? What will be the purpose of carrying out valuation? Why would you like to carry out valuation of any security for that case, or any asset for that case? What's the purpose of valuation is? What's the reason? Why do you want to carry out valuation of any share or any debenture, or for that case, any company in that matter? Right? What is the way? Yep. Yes. Tell me. What is the purpose of carrying out valuation? What's the reason? Okay, for investment, to check whether want to buy or sell. Of course, so we are trying to look for the possibilities, or the whole idea of carrying out valuation is to understand whether a particular security is undervalued or overvalued. Because let's say we go to market and someone quotes you 1 kg of potato as, let's say, 1000 rupees. What will be your immediate reaction to this? 1 kg of potato, if it is 1000 rupees, what will be your immediate reaction to this? Yeah, tell me this. What will be your immediate reaction? Yep. What will be your immediate reaction? What do you think? The immediate reaction which you will have for this sort of thing, You'll obviously say, sir, this is something, which is overly done, or you can say this is something, having a, uh, greater value than what it deserves, right? So you can definitely say that this 1,000 rupees is essentially overvalued, right? And once you have decided that it is overvalued, what will be your next course of action? Yeah. So once you've decided, once you got to know that it is overvalued, what do you think? What are we supposed to be doing with it? Once you've decided that this is overvalued, what are we going to do? Not to buy? Okay, I agree you're not going to buy it. But are you just going to settle it not to buy? Or are you going to do some sort of additional activity with that? Yeah. You can just, I know you can't unmute yourself. You can just type it in the text box. Sell today. Yes. So if having, we should sell it. If we are having a stock of potato, we should sell it, right? They're having a stock of potato, we should simply sell it because it is overvalued right now, right? And of course, you can definitely see what's the other price available in the market, and based on that, you can definitely take the decision. So once you say that this is overvalued, then you go ahead to the next step to understand that it is, you know, uh, overvalued. So you will obviously take a position to sell it, right? So now, what made you say that this is overvalued? What made you say that this is overvalued? Yeah. What made you say that this is overvalued over here? Yeah, guys. What made you say that this is overvalued? So are you comparing it with something? Are you going to compare it with something that will tell you that it is overvalued? Yeah. What made you say this? On the basis of historical price, on the basis of market conditions? Okay. Fundamentally, we should know how much it should be. Or I can see you are essentially comparing this. You are simply comparing the current market price with what we call as the fair value, right? We are simply comparing this current market price with what we call as the fair value, right? So current market price is simply going to be compared with the fair value. And if we say that the current market price is greater than the fair value, what's the conclusion that we draw? What's the conclusion that we draw? The current market price is greater than, let's say, the fair value. What's the conclusion we can draw? If the current market value is greater than the fair value, what is the conclusion that you can draw? So since the current market value is more than this, we can definitely say it is having a overvaluation situation, right? And it means if it is overvalued, you should simply sell it in the market. And if you're comparing current market price and you find that current market price is less than the fair value, if your current market price is less than the fair value, then we should say that this is undervalued, right? This is a typical case of undervaluation, and there we are going to say we will buy the share. So essentially, taking the decision of buying and selling is dependent on two things. One is what we call as the overvaluation or undervaluation is decided on the basis of current market price. You simply compare the current market price with the fair value. Okay, so you're going to compare the current market price with the fair value, and that is essentially going to help us in deciding whether it is overvalued or undervalued. Okay, so what are we really going to discuss in this particular chapter? Okay, so we are going to discuss the valuation of equity shares as well as the valuation of bonds, right? So agenda that we have is simply going to be like, we are going to first value, we're going to carry out valuation of shares, and also broadly we are going to do the valuation of bonds. In fact, we're just not going to value the bonds. We are also going to say valuation of bonds and risk analysis in bond. Some sort of risk analysis will be also carried out. Okay, so that is about the agenda. Now, of course, valuation of shares, we have multiple models. Valuation of bonds, we just have one model, which is taking the present value of future cash flows. But then, yes, we are going to do a lot of things in this chapter which will be new to you. Okay, so let me just go ahead with the valuation of equity shares. Okay, in the shares, we have equity as well as preference shares. So let's first begin with the part of valuation of equity shares. So this is going to be valuation of equity shares. Now we know, sir, carrying out valuation of any asset for that case, valuation or carrying out valuation of any asset for that case, what is the process? How do you value any particular asset? Forget about equity shares, but if I ask you, how do you calculate the value of any particular asset? How do you calculate the value of any asset, guys? How do we calculate? How do you calculate value of any asset? We know, sir, value of any asset is simply going to be value of an asset. If value of an asset is simply going to be present value of all future cash flows. So value of an asset is simply going to be present value of all future cash flows. What cash flows are you expecting from a share? Yes, tell me, guys. What are the cash flows expected from a share? Cash flow expected from share. Yep, tell me. What are the cash flows that are expected from a share? What cash flows are you expecting from the share? Yeah. What cash flows? Of course, we get two cash flows. One is the dividends, right? And the other cash flow will be dividends. And so if you have dividends and the future sale value of shares, Okay. So now, first part, let's say if we are planning to hold the share for just 1 year, if holding period is 1 year, then if our holding period is 1 year, then suppose we are going to get out of this cash, if our holding period is 1 year, we're just going to get two cash flows. One is the dividend in the first year, let's say dividend expected is 10, and price of the share after a year, let's say that is 60. And we're saying that our required rate of return or cost of equity is suppose 12%. So D1 is 10, P1 is 60, KE is 12%. So what will be the value of shares in time zero? Value of shares in time zero. Of course, it's going to be present value of both of them. So I will say D1 plus P1 upon 1 plus K. D1 plus P1 upon 1 plus K. Right? So just give me this answer. D1 plus P1 upon 1 plus K is. So can you substitute it and get the value? Because you're going to get 10 and 60, that which is 70 is the total value, divide by 1.12. So that comes out to be what? 62.5, right? That's the value of the share, which is 62.5. Correct? Right? So value of the share, it comes out to be 62.5. Right? So that is the case when you are having a 62 point or holding period is 1 year. What if uh, the holding period is multiple holding period, or we don't know what is the holding period of the share, right? So let us look at the second case. Valuation based on multiple holding periods. So valuation based on multiple holding period. So valuation based on multiple holding period. Now we can have a variant to this. Let's say to this A part, holding period, let's say it is 3 years, right? Holding period is 3 years. So with the holding period of 3 years, I need definitely D1, D2, D3. So first year dividend is expected is, let's say, 10, second year expected is 12, third year expected is 14. And then you are going to sell this share in the third year for a price of, let's say, 136. And if our cost of equity is, let's say, 10%. So now first case is, you know what is the holding period time. You know that you're going to hold it for 3 years. So since you're very sure that your holding period is going to be 3 years, then we need to definitely calculate this by simply taking present value of all the cash flows. So here the value of shares, will be D1 upon 1 plus K plus D2 upon 1 plus K square plus D3 upon 1 plus K cube. In fact, it will be D3 plus P3. So can we just substitute the values in this? So D1, first year dividend expected is 10. So 10 divided by 1.1. Second year dividend is 12. So it's going to be 12 divided by 1.1 square. And third year, you have the dividend of 14 as well as share price of 136. So this divided by 1.1 cube. So this is a case where we are knowing what is the holding period, right? So this is a case where we say holding period is defined. So if holding period is defined, then we are simply going to take the present value of all the future cash flows. I think you should be able to get this answer. What is this number, guys? Yes. What is this value? Holding period, multiple holding period. If it is held for 3 years, then we simply take the present value of all future dividend and the prices. So this is equal to 131.71. Okay. Now this is a case where holding period is defined, where you are very much sure what is going to be the holding period. Now we may definitely have one more case where the holding period is not defined, or you are not sure what is the time period for which you're going to hold the share. So if holding period is not defined, right? So if holding period is not defined, then what is the situation? Then we may have two further classes. One is constant dividend growth rate, where your dividend is going to grow constantly at a single rate. So constant dividend growth rate. And then, or so wait, instead of saying constant dividend growth rate directly, this we will take it in the second part. We may have the situation where there is zero growth. Second could be constantly while the dividend is growing at a particular rate, right? And also, we may have one more case where it is multi-stage growth rate. So we may have multi-stage growth rate also. Okay. So we may be having a situation of constant dividend growth rate or multi-stage growth rate. So let's first talk of what is this zero growth rate or zero rate of growth. When we're saying multi-stage, we're obviously talking of two-stage, three-stage, and other aspects. But right now, let us focus on the first part, which is the zero growth rate. So when you say zero growth rate, your dividend is constant throughout. So there's no change in dividend that is happening. Your dividend is a constantly growing at a, it's constant throughout its life. There's no change in the dividend that's happening. So which is pretty simple. Value of share. Okay. So value of share is simply going to be value of share is simply going to be defined by the dividends. And we know that if it's a constant, if it's a zero growth rate, then the dividend is obviously going to remain same throughout its life. So you have dividend in the first year, D1. We take the present value by dividing it. The dividend of first year divided by 1 plus k plus dividend of second year, which is same as D1, right? Upon 1 plus k square plus dividend of third year divided by 1 plus k cube plus dividend of fourth year divided by 1 plus k raised to 4, and this goes on till infinity. Because your dividend is constant, you can see that d is constant over there. The d1 is remaining same. Now, does this seem like some mathematical series to you? Does this seem like some mathematical series to you? Yes or no, guys? Does it seem like some mathematical series? Yes. This is a typical case of geometric progression. The geometric progression summation till infinity is a upon 1 minus r. Geometric progression, it's a upon 1 minus r, where a is the first term. So this is a. And r is 1 divided by 1 plus k. So if I just apply the formula over here, which is a upon 1 minus r, where a is d1 upon 1 plus k, the whole divided by 1 minus 1 upon 1 plus k. Right? So d1, and then we can simplify this as d1 upon 1 plus k, the whole divided by 1 plus k minus 1, the whole divided by 1 plus k. So now we subtract this 1 plus k, and what we have is that d1 upon k, because you can say 1 and minus 1 also gets cancelled. So the answer, or the formula, when we say that there is no growth in dividend, right? There is no growth rate in dividend. I think there's no growth rate in dividend. I think Guram, now you can unmute.
Hello, morning, sir.
Good morning.
Sir, actually, in earlier classes, we are unmuting ourselves. When we are required, we will unmute. But in your class,
I think I have
option
enabled it now.
option is not. Okay, thank you, sir. We will answer quickly if we will unmute
Yeah,
immediately.
yeah,
So,
yeah. Sure.
okay, thank you.
Okay, so we have V0 as what? D1 upon K. So it's a very simple thing that if the dividend is, if the dividend is growing, so if the dividend is not growing, then you simply say it's D1 upon K. So that's a zero growth rate. Now, let us look at the second case. So the second case is about now constant dividend growth rate. Constant dividend growth rate. I'm pretty sure you might have already learned this at UCA interlevel, but I'm just formalizing it. Now, when you say constant dividend growth rate, your dividend is going to grow at a constant rate till perpetuity. So here, the value of share is first year dividend upon 1 plus k plus second year dividend. There is a constant growth rate as compared to the zeroth year. So you say d1 into 1 plus g upon 1 plus k square plus third year dividend will be d1 into 1 plus g square upon 1 plus ke cube. And so this just goes on till perpetuity. Again, does it seem like some series to you? Does it seem like some series to you? Yes, right? It's like again a geometric series, geometric progression. So geometric progression, you can say it will be first term, which is d1 upon 1 plus ke divided by 1 minus r. Now what's r over here? Understand, this is your a. And r is 1 plus g upon 1 plus k. So this is 1 minus 1 plus g upon 1 plus k. So this is going to be d1 upon 1 plus k, the whole divided by 1 plus k minus 1 minus g upon 1 plus k. So you can just say 1 plus k gets cancelled, and you have d1 upon k minus g. Just 1 minus 1 also gets cancelled. So finally, we can say value of share when there is a constant growth rate. This is d1 upon k minus g. You might have already learned this in interlevel called as a Gordon formula, Gordon model. right? So we have seen two things. One is assuming that there is no growth, and second is assuming there is a constant growth. Now we may have a situation where this formula doesn't work. Can you identify a situation where this formula is going to give you weird answers? Can you think of a situation where this formula is giving you weird answers? Yeah. Any such situation where you can say that this formula is going to give you some weird answers? Or I can say this formula itself, by its structure, it assumes something. What is that assumption that the formula is putting in? What assumption is being put by the formula base? Well, the biggest assumption that it takes is that your cost of equity is more than growth rate, right? Your cost of equity is more than growth rate. Now just imagine if your cost of equity is 10% and growth rate is 12%, then what's going to be the value of the share? Can I say it will be negative? The value of share will turn out to be negative, right? This correct? Value of share is, if your cost of equity is more than growth, the value of share will be negative. So of course, in that situation, this formula, this model is not applicable. Then which model will be applicable, sir? Then we'll have to look at the next model, which is the multi-stage growth model. Multi-stage growth model. Because when questions were raised at Gordon that, sir, your model is actually failing when your growth rate is high, then the answer to that was given by Gordon by simply stating that, you know, the high growth rate which you are saying is not going to be a feature forever, because a company cannot grow fast or company cannot grow at a higher growth rate forever. It's going to, it's ultimately going to settle down. It's ultimately going to settle down at some number, which is a stable growth rate. So agreed, there will be high growth rate, but that will be limited to few years of operations. That will be limited to some few years of operations, because beyond a particular point of time, the growth rate is going to be definitely settling down to a smaller number. The growth rate is going to settle down to a smaller number. Okay. So how is that really going to happen? The multiple stage growth model is what we are going to look at now. The multi-stage growth model. Yeah. Multi-stage growth model. Well, this multi-stage growth model, let's try to understand that with the help of an example. Uh, yeah, let's try to understand that with the help of this question number 3, guys. See, M&P Limited has declared and paid an annual dividend of ₹4 per share. The company has declared a dividend of ₹4 per share. So the company has declared a dividend of 4 per share. So what is this 4? What is this 4? Can I say this is 4? This 4 is D0, which is dividend in year 0. Correct, guys? Yes. This 4 is essentially dividend in year 0, right? Which is the current dividend also, you can say, which is like your, which is exactly the current dividend, right? Now, with the given level of current dividend, what are other aspects are given over here? See, it expects to grow at 20% for next 2 years. Okay, so growth rate is defined Growth rate is defined as what? 20%. But this 20% is for year 1 and 2. So this growth rate of 20% is valid for only year 1 and 2. Okay. And 10% thereafter. So 10% is from year 3 onwards. So from year 3 onwards, the growth rate is going to be 10%. The required rate of return for equity investor is 15%. So cost of equity is 15%. Okay. So we can say that the share is going to grow at a high growth rate for initial 2 years, and beyond that it will settle down to a normal growth rate. So now this is a typical situation that we have year 0, year 1, year 2, year 3 onwards, right? So in between year 0 to 1, there will be a growth rate of 20%. Between year 1 to year 2, there will be a growth rate of 20%. And then from year 2 till perpetuity, the growth rate is 10%. The growth rate is 10%. So now, with the given circumstances, can we apply the Gordon formula over here? With the given situation, can we apply the Gordon formula? No, we can't apply, because Gordon assumes that there will be a constant growth rate, right? And moreover, it also assumes that your K has to be higher than the growth rate. So what we are saying is, we have now two stages of growth rate. First, from year 1, from year 0 to year 2, we have 20% growth rate, and beyond that, it is 10% growth rate. Okay, so today I can't apply the Gordon formula, but can you tell me in which year can I really think of applying the Gordon formula? In which year can I apply the Gordon formula? I can't apply in year 0. Can I apply in year 1? No, because even in year 1, you say the next year growth rate dividend is different. But at the end of second year or at the start of third year, we can apply the Gordon formula. Correct, everyone? Yeah. So at the end of second year, or I can say at the start of third year, I can apply the Gordon formula. Okay. So we will apply that, but before that, we need to get the present value of the dividends. We need to get the present value of the dividend. For that, we need to compute the dividend amount. So as a first step, we are going to first calculate the dividend amount. So we'll say year and dividend. So year 1, 2, 3. The first dividend will be 4 multiplied by 1.2, because we need a growth rate. So that's your 4.8. Then 4.8 into again 1.2. There will be 5.76. 5.76 multiplied by. Now what should be the growth rate I should multiply this with? 5.76 should be multiplied by what number? 5.76 should be multiplied by what number, guys? It should be multiplied by 1.1, because now the growth rate is 10%. So this is 6.336. Okay, that's your 6.336. Now, I would like to say, I can get the value of the share in year 2. Value of share in year 2. Just like, remember, value in year 0 is D1 upon K minus G. If the dividends are going to grow at a constantly growth rate, then this formula applies. Same way, what can I say about the value of the share in year 2? Value in year 2, or which we call it as terminal value in year 2. Terminal value in year 2. What will be the value of the share in year 2? Terminal value That will be what? D3 upon KE minus. So terminal value in year 2 will be D3 upon KE minus G. So D3 is 6.336 divided by KE minus G. KE will be 0.15 minus growth rate of 0.1. So 6.336 divided by 0.15 minus 0.1. Right? So what is this value? Value of share in year 2 or terminal value in year 2. What is this number, guys? 6.336 divided by 0.15 minus 0.1. Yeah. How much is it? 120. 6.336 divided by 0.05. No. Yeah, divided by 0.05. 126.72. Now, this is the value of the share at the end of second year. This is the value of the share at the end of second year. Now, of course, I want the value of share today. So, value of share today will be determined by simply taking the present value of all the cash flows that you're going to get. So here, let's say description, cash flows. Let's take the present value factor at 15% and we take the P. So in year 1, we are going to get the first year dividend. The first year dividend is 4.8. In year 2, we are going to get the second year dividend, which is 5.76. And in third year, in fact, we are not going to the third year also. We are simply saying in the second year itself, we are getting the value of the share in second year, P2, which is the valuation of value of the shares in the second year. The value of the share in the second year is 126.67. So if I'm going to buy the share today, I will get 4.8 dividend in first year. I'll get 5.76 dividend in the second year, and also I'll get the share sale value of the share, which is 126.7. So just take the present value and then add it up. Take the present value and add them all. One 126.72. Sorry, this will be 126.72. This is 126.72, guys. Yeah. Got it? So just take the present value of all of them. Take the present value factor at 15% and give me the value. Good morning. Voice not coming. Okay. So we have D0 as 14. Growth rate is 9% for year 1 to 3. It will continue for 3 years. He also expects the market price of the share to be 360 after 3 years. So what is this 360? Can you tell me what is this 360? So we have a dividend of year 0, growth rate of 9%. What is this 360? Yeah, 360 is what? Value of the share in year 3 is 360. So the terminal value is given to you, 360, right? Okay, so you are required to determine the maximum amount we should be pay for the share because the return of 13%. Okay, so required return key is 13%. So I can definitely say that this is year cash flows present value factor at 13%, and then we take the PV. So year 1, 2, 3, and 3. So in year 1 you have 14 dividend. Dividend in the second year will be obviously with a growth rate of 9%. So after accounting for a growth rate of 9%, what's the dividend? 14 into 1.09, which is 15.26. So this further multiplied by 1.09. Sorry. So D0 is 14. So 14 needs to be growing by this. This is 15.26 in the first year. Second year, it's going to be 16.63. This multiplied by again 1.09. Third year dividend is 18.13. And the value of the share in third year is set to be 360. Now we can simply apply the PV factor at 13%. Okay. Growth rate will be 9%. Growth rate will be 9% because the question says that growth rate is going to increase from 8% to 9%. So obviously, anticipated it is 9%, which will continue for 3 years. And then he expects the market price of the share after 3 years will be 360. So this 9% is going to continue for 3 years, means year 1, 2, and 3. 3 years you're going to have a growth rate of 9%. Okay, got it? So the language is what? Increase in growth rate from 8% to 9%, which will continue for 3 years. So continue for 3 years means in the upcoming 3 years, the growth rate will be 9%. Earlier, it was 8%. Get the present value is? Yeah, give me the present value. Take the present value of all the cash flows. Discount it at 13%. So your PV factors will be 0.885, 0.783, 0.693. So present value is 288.61. No, 288.61. That will be the present value. Okay, that's the first part. Now the second part of the question is the maximum price D will be willing to pay for the share if he is of the opinion that 9% growth can be maintained indefinitely and requires 13% rate of return. Now he's saying that suppose if this 9% is going to be constant, then which model are we going to apply? The investor is saying that 9% is going to be a constant growth rate. Which model can we apply? They're saying we can have a constant growth of 9% indefinitely. If you're expecting a constant growth of 9% indefinitely, then definitely we can apply which model is? Gordon model. Yes. So Gordon model, the formula is what? D1 upon K minus G. D1 is 15.26, which is the first year dividend, and you divide it by K minus G, where K is 13% and growth rate is 9%, which is 0.09. So 15.26 divided by 4% divided by 0.04. So the share value comes out to be how much? 381.50. Yes, that's the value of the share. Then the third part is the price of the share at the end of 3 years if 9% growth rate is achieved and assuming other conditions remain as in 2 above. Now they're saying what will be the value of the share if the dividend is going to grow constantly at 9% in third year. Okay, so value in third year, we want value in third year. Value in third year, we know it will be dividend in fourth year divided by K minus G, right? So dividend in fourth year will be dividend in third year into 1 plus G upon K minus G. So that's simply going to be dividend in third year is what? 18.13 into 1.09 divided by K is 13% minus 0.09. So it's simple. We want the value of the share in third year, assuming that 9% is going to be the growth rate forever. So we simply apply this formula D4 upon K minus G. And once we substitute this, what's the value of the share? 494.04. Yes, that's 494.04. Okay, great. Let us look for an interesting question now, which is question number 6, guys. Look at this question. It's quite an interesting question. Just read this question for a while. Read this question for a while. Yes. So Piyush Ronkar, presently pays a dividend of 1 per share and has a share price of 20. If this dividend were expected to grow at a rate of 12% per annum forever, what is the firm's expected or required return on equity using a dividend discount model? So first we need to get the return on equity or KE, correct? Secondly, instead of this situation in part one, suppose the dividends are expected to grow at a rate of 20% per annum for 5 years and 10% per annum thereafter. Then now the firm's expected return on equity will be how much? Okay, so a bit different question. So we have information of presently paid of dividend of 1 rupee. So it presently paid a dividend of 1 rupee. This simply means we have the price of share as 20. Firm's expected or required return on equity using dividend discount model. So firm's expected or required return on equity. So again, using this Gordon model, so K will be what? D1 upon P0 plus G. So D1 will be 1.12 because dividend of 1 and that a growth rate of 12%. So D1 will be 1.12 divided by 20 plus a growth rate of 12%. So 1.12 divided by 20 plus a growth rate of 0.12. So what is 1.12 divided by 20 plus this? That's around 17.6%. Pretty simple. Now, the second part says, instead of this situation, part one, suppose the dividend is going to grow at the rate of 20% for 5 years and 10% per annum thereafter. What is the firm's expected or required return on equity? Okay, so let us first get the uh, dividend terms. Okay, so in the second situation, or in the second part, I need to get uh, the value of the share today at some rate which we are not available, which we are not knowing it at this stage. Right. So this is a typical two-stage dividend model, two-stage dividend growth model. So let us do it by interpolation or by just some sort of estimation. Okay. So let us assume let K for two-stage dividend model be, let's say, 20%. So we are assuming, suppose the K for a two-stage dividend model is 20%. In that situation, what will be D0? D0 is definitely 1, but then they're saying growth rate is 20% and 10%. So 20% is from year 1 to 5. 10% is from year 6 onwards. So looking at these things, we can definitely say year cash flows, EV factor at 20%, and then PV. Okay. So remember for this, we have year 1, 2, 3, 4, 5, and 5. So I need the dividend values. This will be D1, this will be D2, this will be D3, D4, D5, and P5. We know that P5 or fifth year price can be computed as D6 upon K minus G. D6 upon K minus G. So for D6, I need to get these dividends. So dividends are going at what? 20% for first 5 years. So first year it will be 1.2. Second year it will be 1.2 into 1.2, which will be 1.44. further multiplied by 1.2, 1.73, further multiplied by 1.2, 2.07, further multiplied by 1.2, 2.49. Of course, D6 will be now 2.49 into 1.1, because now the growth rate is of course 10%, so divided by 0.2 minus 0.1. So what is this terminal value? Growth rate. Growth rate is given 20%, right? So I just assume that K to be 20%. I'm just taking a higher rate, and this will see what is the value. So I need to match the value with the current price of 20. If it is not matching, then we'll have to change this rate and get the new value then. So we are going to do that interpolation or IRR calculation sort of thing. Okay. Yeah. So D6 upon K minus G. So that's 2.49 into 1.1 divided by 0.1. Yeah. So value of the share is 27.39. So P5 price in year 5 is 27.39. So if I'm going to discount my cash flows at 20%, give me the PV value. Give me the present value if I'm discounting these cash flows at 20%. Because 20% is anyways an assumed number. So just see what's the present value of all these cash flows together. Give me the present value. Yeah, so present value is what? 16.02. Okay. But what is the present value that we need? The value of the share today is, you know, we have the value of the share today as what? 20, right? So of course, by taking 20% as a discounting rate, we are not getting the value. We're getting the value of 16.02. So we need 20. So what should I do with this 20%? Shall I increase it or decrease it? Shall I increase it or decrease it? Of course, we need to decrease it, right? So we'll say let K be, suppose 15%. So let us take it as 15%. And let's write down the same way here cash flows present value factor at 15% and PV. Okay, so we have here 1, 2, 3, 4, 5, and 5. Now, the dividend values will be 1.2 0.15. No, so dividend is, the dividend values are going to be the same, which is 1.2, 1.44, 1.73, 2.07, 2.49. But yes, the value of the share in fifth year is going to be different. So value share in fifth year, it will be 2.49 into growth rate of 1.1 divided by 0.15 minus 0.1. So what's the value? 2.49 into 1.1 divided by 0.05. 54.78. Okay. This is 54.78. So cash flow is 54.78 in the fifth year. Now we can definitely get the present value factors at 15% and take the total of PVs. Check at 15% what is the value? At 15%, what is the value of share that we're getting? Just check it. And then we have to carry out the interpolation. Present value is what? 32.92. Okay. 32.92. Now, of course, we simply need to carry out the interpolation because for a given key, we have the value. So for a key of 18%, no, sorry, not 18%. For a key of, we had 15%, the value was 32.92. And for a key of 20%, we have the value as 16.02. So now we simply carry out the interpolation between them. So we are saying what is the observed change? K has increased by 5%. Value has decreased by how much? Value has decreased by 32.92 minus 16.02, which is 16.9, right? Now, of course, when we carry out the interpolation, we want the value to be reduced to, we want this 32.92 to be transforming to 20. So the reduction that we want is 12.92. This is a required change. So what will be the percentage change? Percentage change in K required will be 12.92 into 5 divided by 16.09. So the required change is how much? 12.92 into 5 divided by 16.9, which is 3.82. So the K will be 15% plus 3.82. K will be 15% plus 3.82, right? So 12.92 into 5 divided by 16.9. So the K will be how much? 18.82%. Got it, this, everyone? Whenever we have this multiple stage and we want the K applicable, then of course the only way of doing this is by carrying out the interpolation activity. Are we clear? Everyone? 12.92. See, we wanted the share value to be what? From 32.92 to 20, right? We wanted the share value to reduce to 20. So of course we have observed a change of 16.9, but I want the value to be 12.92. So it's simply 32.92 minus 20. This is 32.92 minus 20. Okay. That is okay. Now after that, we are going to have the next aspect called as earnings based model. Earnings based model. So earnings based model are not going to be dependent on dividend, because there may be certain companies, which may not be paying out dividends. So for them, we apply this earnings based model. So the earnings based model is similar to initial the Gordon model. I'm pretty sure that Gordon model, you're aware of it now, and we can actually define this by simply saying, sir, P1 is what? B1 upon K minus G, right? So instead of that, I can actually say, sir, this is EPS of first year multiplied by dividend payout divided by K in our equity is 15%. So return on equity is 15%, which is essentially your R. Company's policy of retaining 60%. So retention ratio is 0.6 or 60%, right? Then opportunity cost of capital, K is 18%. Okay, so we can get the earnings per share by simply saying, sir, we have the book value as 137.8, right? And we are generating a return of 15%. So having a book value per share of 137.8 and return on equity is 15%. So that will simply book value per share into the return on equity. So book value per share is 137.8 into return on equity is 15%. So 137.8 into 15%. EPS is what? 20.67. So earnings per share is 20.67. Okay. So we have the book value per share into return on equity, which is 137.8 multiplied by 15%. That's 20.67. That's our EPS, right? What about the dividend per share? Dividend per share is going to be 20.67. Out of that, 60% is retained, right? So 1 minus 0.6. So that's 20.67 into 0.4. 20.67 into 0.4, which is 8.27. So that's the amount of dividend which we have. Now we can definitely apply the Gordon formula and the Walter. Now, as per Gordon, price will be EPS expected in the first year into 1 minus B upon K minus G. So we have EPS as 20.67 into 1 minus 0.6 divided by K is 18% minus the growth rate. So I need to get the growth rate over here. So we can get the growth rate as simply B into R, which is 0.6 into 15%. So 0.6 into 15, which is 9%. 0.6 into 15%, which is 9%. So growth rate is 0.09. So 20.67 into 0.4 divided by 0.09. This comes out to be what? 91.87. Then apply the Walter model, which will be P0 into dividend plus earnings upon dividend into dividend plus earnings minus dividend into R upon K, the whole divided by K. Yep. Get the P0 value. Instead of EPS, can we take dividend? Yes, you can take. You can take, like, instead of saying EPS into 1 minus B, you can simply take D1 upon K minus G. That will also work. It will anyways give you the same answer. Yes, return is what? 103 point. So the distributions will be what? Dividend is 8.27 plus earnings of 20.67 minus 8.27 into R is 15% divided by KE is 18%, and then this whole thing divided by 18% of KE. Yeah, so this gives us a value of 103.33. Correct. That's 103.33. That's the value for Walter model formula. Okay, fine. Now, after that, um, let us go for the other aspect. Now we're looking at the other aspect of equity valuation, wherein if we have a situation where the company is not paying any dividend, can you think of any company which may not be in a position to pay dividend or which may not be paying dividend? What could be a situation where the company is not paying dividend? Yeah, tell me. What could be a situation where the company is not paying dividend? Can you say if the company is having loss? Need not be. Even if it is a profit-making company, it may not be actually able to pay the dividend because it's continuously reinvesting, right? It could be a possibility that company doesn't want to pay dividend and it wants to go for reinvesting the money, right? Or it doesn't have sufficient cash flow maybe. So for such companies where the dividend is not paid, we are looking at it in a different perspective, that we are going to calculate the value by using free cash flow. So equity valuation will be done by simply taking present value of equity cash flows, right? So, or free cash flows. So we'll say equity valuation using, so that's like an outflow, right? Because you have give, how would have debtors increased from 10,000 and plus and minus changes in working capital. We can also calculate it using another approach called as cash flow from operations. So you have CFO, cash flow from cash flow statement. To that you add back interest into 1 minus T, and then plus or minus capital expenditure, right? And simple, if we say what is the free cash flow for equity, then how much is the free cash flow which is left for equity? We can simply say it is free cash flow for the firm. It's simply free cash flow for the firm minus interest into 1 minus T, free cash flow for the firm minus interest into 1 minus T minus principal repaid less preference dividend plus any new loan raised. So what is the cash flow that is available for equity? So we say whatever is available for the firm, from that you subtract whatever is payable to the loan providers, pay to the preference dividend, and if you're getting any new loans, consider for that also. So EBITDA is already included depreciation, you again added. No, this is EBITDA is not included. This is earnings before interest, tax, and depreciation. I'm just adding back depreciation into tax rate. CFF, we didn't subtract interest, right? See, we have in fact added back the interest. So I'm going to remove that interest in FCFE. Okay, so these are some of the ways to calculate FCFF and other aspects. Okay, so we'll discuss more about them uh, after the break. Okay, so let's just take a break right now. After that, we will apply this formula in valuation of equity shares. Okay, so let's just take a break, guys. Break of for around 10 minutes. Okay, so just try to recollect these formulae. Try to just assimilate this formula, and then we will be applying this formula into the discussion. Okay. Technical team, Sanket, just make me host.
Done, sir.
Done.
Yes, sir.
Okay. वीडियो आ रही है मेरी? पता नहीं आ रही। स्क्रीन शेयरिंग चल रही है? स्क्रीन शेयरिंग दिख रही है? नहीं, ये भी नहीं दिख रही है। स्क्रीन शेयरिंग हो रही है। अच्छा। ठीक है। वो लिखा हुआ दिख रहा है कि नहीं? पता नहीं, कैमरा।
सर आपका कैमरा ऑन है पर वीडियो नहीं आ रही।
हाँ, वही मैं बोल रहा हूँ, कैमरा का क्या इशू है। कैमरा तो ऑन हो रहा है बट वीडियो नहीं है।
सर ये तो दोबारा से कीजिए, नहीं तो इसी के साथ कंटिन्यू
भी
कीजिए।
जस्ट अभी जस्ट ज्वाइन किया, एक सेकंड में कैमरा दूसरा चेंज करता हूँ, नहीं तो।
या जगबंधु सर पढ़ाते रहिए, कोई बात नहीं।
कोई
हाँ
बात
सर,
नहीं।
मैं भी वही कर रहा हूँ,
ठीक
इसी
है।
के साथ
हाँ
कंटिन्यू कर
प्लीज
सकते
कंटिन्यू सर।
हाँ हाँ, स्क्रीन
ओके,
तो है ना, स्क्रीन इज विजिबल।
हाँ स्क्रीन आ रही है,
हाँ तो
स्क्रीन
फिर
इज
ठीक।
विजिबल।
ठीक है, पता नहीं कैमरा कुछ तो टेक्निकल
गो
इशू
अहेड
है।
प्लीज।
Okay, so free cash flow for equity. We have already discussed these aspects with regards to the free cash flows. Now, let us take it ahead with calculating the value of the share, taking into account the free cash flows. Now, remember, just as we did the present value of dividend, just as we did the present value of dividend, on the similar lines, we are going to plan for the present value of the free cash flows. The idea of free cash flow is that the cash flow which is available freely with the company for distribution amongst equity shareholders. That's your FCFE, right? So after payment of interest, after payment of the principal amount due, preference dividend, and any additional loan that you have raised, after accounting for all of that, whatever is left out, that's essentially our free cash flow for equity. Okay, so let's just apply this with one of the questions. Let us take up. Yeah, question number 10. Let's take up question number 10 for understanding the free cash flow concept in equity valuation. So we have profit after tax of the company as 290 crores. So since the profit after tax is 290 crores, I can get the earnings per share. So we have the earnings per share or net income per share. That will be 290 divided by earnings per share. So we have this 290 divided by the number of equity shares. Now the number of equity shares needs to be computed because see the share capital is given as 1300, but the par value is 40. So I need to get the number of equity shares. So number of equity shares is 1300 divided by 40. So the number of equity shares are 32.5 crores. Okay. So 290 divided by 32.5. 290 divided by 32.5 is 8.923, right? So 290 crores divided by 32.5 crores, that gives us an EPS of 8.923. But remember, we have to calculate over here the value share based on FCFE model. Okay, so value share using FCFE model. So first I need to get the FCFE or free cash flow for the equity. Now free cash flow for equity, we're going to calculate it on a per share basis. Free cash flow for equity will be calculated on the basis of a per share. So we're going to consider the per share impact, and then we are going to get this value. So we have earnings per share, which is your net profit per share. To that, we will add back depreciation. Of course, all our numbers that we have are going to be on a per share basis. So depreciation per share less the capital expenditure on a per share basis less the working capital expenditure, that will be also calculated on a per share basis, or working capital changes. Add back new debt that we are raising. Okay, so this is the way we are going to calculate the FCFE for the share. So this is going to be free cash flow for equity. So we have depreciation per share given in the question. Depreciation per share is 39. So we'll add back depreciation 39. Capital expenditure on a per share basis, that's given as 47. Working capital expenditure, which is essentially working capital change, is 3.45 per share. So that's going to be again 3.45. This will be subtracted. Even 47 is going to be subtracted. And what's the new debt that we are going to raise? See, debt ratio, which is debt upon debt to equity, is 27%. So it means whatever new investments you are having, that will be done by way of some amount coming from equity and some amount coming from debt. Okay, so we need to know what is the new debt raised, the amount of new debt that we are raising. So let's try to calculate that first. New debt raised. So new debt raised is, first we will say what is the change in the current assets and change in the non-current assets. So change in current assets. So the change that we are getting in the current assets is 3.45. So we are going to spend 3.45. We're going to spend 3.45 crores in investment in the current assets. Then what is the change in the change that we have in the non-current assets? Now, of course, in the non-current assets that you see, 47 being your capital expenditure and depreciation being 39. Right, so 47 will be the new capital expenditure, and we are also going to get a depreciation of 39. So the net change in non-current assets will be 8. Right, so that's going to be 47 minus 13. So net change in current non-current assets will be 8. So total additional funds that will be invested, total additional funds to be invested, total additional funds that will be invested, that will be 11.45. Okay, so the total is going to be 11.45. Now this 11.45 investment which is going to be done, that is not done by way of fully equity. A portion of that is going to be funded by debt. So what will be the new debt that we are raising? New debt to be raised will be 11.45 into 27%, because 27% was the ratio. So the new debt that we're raising is 3.092. So new debt that we're raising, that will be a inflow, right? There will be cash inflow because we're raising this debt. So 3.092. And if you just sum up all of them, 8.923 plus 39 minus 47 minus 3.45 plus 3.092. What's the free cash flow for equity? Free cash flow for equity on a per share basis. Give me the total free cash flow for equity. The total free cash flow for equity is 0.565. Okay. Now we got the free cash flow for equity. Rest is I need to compute the amount of cost of equity, and for that we do have the risk-free rate. We have the risk-free rate 8.7%. We have the market return 10.3%. We have the beta. The beta is 0.1. Now with this RF, RM, and beta, I'm pretty sure we can calculate the KE also using CAP. So KE using KPM model will be RF plus beta into RM minus RF. That will be 8.7% plus beta of 0.1 into 10.3% minus 8.7%. So let's just add them. So 10.3 minus 8.7 into 0.1 plus 8.7. So the cost of equity is 8.86%. 8.86%. Okay. They have also been provided with the growth rate, which is 8%. Now, just like we had in Gordon, P0 equal to D1 upon K minus G. Instead of D1, we are going to replace it. We are going to replace it with free cash flow for equity for the first year. So this is the amount of free cash flow which is available with the company. Whether it pays dividend or it doesn't, that's a secondary story. But if it is having a free cash flow, this is definitely something that is due for the equity shareholders. So we can say free cash flow for equity is going to be 0.56, or I can say free cash flow for the first year, that will be FCFE for 1 plus G multiplied by 1 plus G, and then divided by K minus G. FCFE into 1 plus G divided by K minus G. Now FCFE for 1 plus G will be 0.565 multiplied by 1.1, because the growth rate given in the question is long run is 8%. Sorry. So long run growth rate is 8%. So 1.08 divided by K is what we computed, 0.0886 minus 0.08. So what's the price of the share? What's the price of the share, guys? What is it? 20.95. Yes. That 70.95 is the value of the share. Okay, great. That's pretty simple. Question number 10 is done. Now, just as we did over here for free cash flow for equity on a per share basis, you can also do it on a total basis, and of course get the value of the share on the similar names. Okay. Now let me just give you an example to get it fixed. So let's say you have a profit after tax of 3,000. You have the depreciation number as 450. PAT of 3,000, depreciation is 450. Let's say working capital, which is the opening working capital. We have opening working capital as 670, and 880 is the closing working capital. Capital expenditure, which is planned, that is, let's say 150. New debt is 120, and let's say debt repaid is 250. Okay, we have the tax rate as suppose 30%. Preference dividend paid is 45. Okay, equity dividend is, let's say, 70. Interest is, let's say, 47 crores. I want you to give me the FCFE number, guys. Take a minute and try to get the FCFE number. Just take a minute and try to get the free cash flow for equity number. I've given you all the information. Just try to give me the free cash flow for equity number. Free cash flow for equity. So I'll just give you the formula. So we start with PAT, add back depreciation, less capex, okay, less working capital expenditure, add new debt, less debt repaid, less any preference dividend that you're paying. So just substitute in this. and get the free cash flow for equity. Substitute in this and get the free cash flow for equity. So that will be 3000 minus 450 plus 450 minus 150 less working capital expenditure. So working capital expenditure is basically whatever is the increase in the working capital from 670 to 880. So that's essentially 210. So less working capital expenditure minus 210 plus new debt raised, which is 120, minus debt repaid is 250, minus preference dividend of 45. What will be the answer? In the formula interest net of tax, why should I reduce interest net of tax? Because interest net of tax is already taken care in PAT, right? In PAT, you would have already subtracted the interest. So why I'm going to subtract it again? You subtract interest when you're starting with EBIT. Got it? So what is this FCFE then? Free cash flow for equity. Yeah, towards FCFE, it is 2915. Yes, 2915. Okay. Now, just as we have with FCFE, if I give you the growth rate of, let's say, 40%, growth rate is 40% for first 4 years. Let's say the growth rate is 40% for first 4 years and 10% for year 5 onwards. And if I give you the KE, that's going to be, let's say, 15%, right? So can you get the value of, value of the company? Can we get the value of the company? Yes. Can you get the value of the company? Value of the company will be what? Simply taking present value of all future cash flows for equity. So you can just take this and you can just practice it after today's class. It's on the same line. You have to just carry out the two-stage discounting. Okay. Just to give you the final answer, you can just verify it after class, just as like the homework over here. You can just see the value should be 1603.9. So this is like 2915 is the free cash flow for equity. Okay. And the cost of equity is 15%. Growth rate are two stage given to us. So 1603, rather it will be 160390. Yeah. This will be the 1,60,390. Yeah. This will be the value of the shares. Value of the equity shares of the company, I can say. Okay. So this should be the value. You can just verify it later as a homework. Take it in the two-stage format. Just as we did the equity shares two-stage format, same way, even this FCFE needs to be discounted using a two-stage model. Okay. Are we good, everyone? I think you'll be able to do it. Correct? Guram? Rachit? Can you solve this? And homework, yes? Just practice it. It's like similar your two-stage model. So where two-stage model, this is going to be your value. No, this is going to be your FCFE in year. This is going to be FCFE in year 0. The same way you get the FCFE for the first year, second year, third year, fourth year, and then just discount it using the model that we have discussed earlier. Okay. Now, before we go to next aspect, one important thing that I need to highlight to you is a limitation or some sort of shortcoming in the two-stage model. See, normally what we see is, we see that the growth rate, let's say it is 30% for 4 years. Okay. And then we say the growth rate reduces to directly 10% in 10% from year 5 onwards. So growth rate is 30% for 4 years and 10% from year 5 onwards. Growth rate is 30% for 4 years and 10% from year 5 onwards. Okay. So do you see any problem or anything which you can say as there is something wrong with this model? When I say that the growth is 30% for 4 years, and immediately next year the growth rate falls to 10%. Can you think that really is this really something which is practical? Is this really something which is practical, or do you challenge it? Yeah. Or let me just put it like this. Let me just put a diagram for you. Year 1, 2, 3, 4, 5. Let me extend it. 6, 7. So year 1, 2, 3, 4, 5, 6, 7. Okay. So we have like a 30% growth over here. This is, let's say, 20%, and this is, let's say, 10%. Okay. And it is like you're having a growth rate 30% for first year, for second year, for third year. So 30% for first year, second year, third year, and even for the fourth year. And then you're saying suddenly from year 5 onwards, the growth rate falls abruptly to 10%. Does it seem to be like problematic? Yes, sir, definitely. Because if you're saying that the growth is drastically reducing from 30 to 10, it is something which is quite challenging. How come in just 1 year the growth rate reduced to 1/3? Right? So ideally, how should the growth rate be then, guys? How should the growth rate be then? How should the growth rate be then? Tell me. Any better way of assigning or calculating a growth rate? Any better way? Can I say we can make it actually more, what do you say, streamlined, or a bit of gradual reduction in the growth rate, right? So suppose if I say like this, so growth rate is 30% for 4 years, and let's say 10% from year 9 onwards. And then I'm saying year 5 to year 9, year 5 to year 9, year 5 to year 9, there will be gradual fall in growth rate. The growth rate should reduce slowly and steadily to 10%. And for that, we are having a time frame of 4 to 9, which is a transition phase, right? So here we say year 1 to 4, there is high growth phase. Then year 5 to 8, or you can say there is 5 to 9, there is a transition which is happening. And 9 onwards, there is a stable growth rate. So year 9 onwards, there is a stable growth. So for year 1 to 4, there is high growth. 5 to 9, there is a transition. And then from 9 onwards, there is a stable growth rate happening. So what will happen over here, the diagram, I'll let you know the diagram, and then we will see the growth rate calculation. See, there are 0, 1, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Then also. So we have a high growth rate. This is 10, 20, and 30. I'll do it like this. 10, 30, 30%, 20%, and 10%. So we have a high growth from first year to fourth year. No doubt in that. Okay. We have a high growth rate from first year to fourth year. Okay. But then after that, we see that from 9th year onwards, there is a constant growth rate. And in between this, there is this transition which is happening. Right? So you can see there is a gradual fall. There's a gradual fall in the growth rate in the transition phase. And this gives us a more sensible way of understanding this thing. Okay, so let's try to understand how do we get the growth rate in between this. Okay, let's understand this with the help of a number. Suppose D0, which is a dividend today, is 20, and growth rate as we defined 30% for 4 years, 10% from year 9. Then our K is 15%. Right, so in between year 4 to 9, we have the transition phase. Now, first that we need to understand is that we start with the year, we define the growth rate, right? Then we say what are the cash flows, and then of course we can simply take the present value factor and then the PV. So year 1, we have growth rate of 30%. Year 2, we have growth rate of 30%. Year 3, also 30%. Year 4, also 30%. Now year 5, 6, 7, 8, we don't know. But then from 9th year onwards, year 9 onwards, the growth rate is 10%. 9th year onwards, the growth rate is 10%. So now the question is, what will be the growth rate in year 5, 6, 7, and 8? Can you tell me what will be the growth rates? The growth rate should be falling gradually from 30 to 10%. So can you tell me what will be the growth rate from year 5 to 9 or from year 4 to 9? What will be the growth rate, guys, from year 4 to 9? Yes, between 30 to 20. Of course, it's going to be between 30 to 10. But every year, what should be the reduction in the growth rate? I mean, what is the growth rate in 5th, 6th, 7th, and 8th? I want the specific number. I know there's a fall of 20% from 30 to 10 from 4th year to 9th year. But every year, what should be the change? Every year, what should be the change? Every year 5% reduction. So if you're reducing it every year by 5%, that will be 25, 20, 15, and 10. No. 2. Then 18, 14. Can you see now the transition is smooth? Every year there's a reduction of 4%. Did we get this, everyone? In the transition phase, the growth rate has to be reduced by 4% every year. So it matches to the final year of 10%. Now we can definitely get the value of the share by taking the dividend values. So dividend will be 20 into 1.3, which is 26, right? Further, 26 into 1.3, which is 33.8. Then 33.8 multiplied by 1.3, which is 43.94. Then 43.94 into 1.3, 57.12. Then next is 57.12 into 1.26. So that will be 71.97. Next one is 71.97 into 1.22. 1.22, which is 87.81. Then we have 87.81 into 1.18, which is 103.61. Then 103.61 into 1.18, which is 118.12. And finally, in the 9th year, the dividend will be 118.12 into 1.1, which is 129.93. Okay, so these are the dividends. But wait, I also need to get in the 9th year value of share in the 9th year. Now, how do I get the value of share in 9th year? It will be dividend of the 10th year divided by K minus G. So dividend of 10th year will be D9 into 1 plus G upon K minus G. So D9 value, you can get the D9 value. D9 value will be D8, sorry, D9, which is 129.93 into the stable growth rate is now definitely 10%. So into 1.1 divided by K minus G. So K is anyways what, 15%. So 0.15 minus 0.10. Okay. So 129.93 into 1.1 divided by 0.05. How much is the value of the share, guys? 129.93 into 1.1 divided by 0.05. So the value of the share is 2,858.46. So we have this as 2858.46. Okay, 2858.46. So just multiply this with the PV factors to arrive at PV. Now the present value factors will be at what, 15%. So we divide 1 divided by 1.15. This is 0.87. Then we have 0.756. Then we have 0.658. Then this is 0.572, 0.497, 0.432. It should be 129. Yeah, 10th year dividend, correct. Guru, we need 10th year dividend for value of the share in 9th year, right? We have calculated the value of the share in 9th year. So for getting the value of share in 9th year, I need the dividend of 10th year, right? If you want V8, then you will take D9. Got it? If you want only the 8th year value, then you take D9, right? We are calculating the 9th year value. So that will be by taking the 10th year dividend. Okay. So after 0.432, then we have 0.376, 0.327, then 0.327 further divided by 1.15. This will be 0.284. This is also 0.284. And now we can definitely get the present value. Present value. Take the total. Try to quickly get the value. Present value is. This is a 3-stage model. This is a 3-stage model, also called as Hiller's model. 3-stage model or the Hiller's model, where there is a smooth transition in growth rate happening. Get the present value is total value of the share. Get the value of the share today. Yeah. So we're calculating the 9th year and 10th beginning or 10th year end. This is 9th year end. We're calculating the 9th year end. This is 8th year, right? And we discounted further by this thing. And the end value, because 10th year beginning, then P value factor value 0.32. 0.327 is the present value factor for the 8th year. Okay. Yeah. Got it? Yeah. So we have This is the ninth year PV. So PV factors will be for the ninth year. Cash flows in the ninth year. So we take the PV factor of the ninth year. So total of all of them is going to be what? 1110.56. 1110.56. That's the present value, or that's the value of the share using the three stage, you can say, or it's a transition phase present value calculation. Are we good, everyone? Okay. Now we have a question which I would like to give you as homework. Okay, yeah. So this question number 31. This is one of our past exam papers, past exam question, where they're saying it's having a 5-year transition phase. Current growth rate is 15%, which will decline linearly to a stable perpetual. The transition phase is 5-year. So we are starting directly from the transition phase. So current data, we have the return on equity and retention ratio given to us, right? And it has paid a dividend, that's also given. So we have the terminal data, which is the return on equity of 12% and retention ratio is 50%. Of course, from this you can get the growth rates under both the phases, right? So growth rate in high growth phase and growth rate in the and growth rate in the stable growth. And then you have the market required return as 13%, and current market price is fine, that's 850. You have to get the intrinsic value using H model. H model is nothing but the same transition phase that we are going to talk of. So I want you to try this question 31 as homework, okay? And in the next class, we will discuss the solution for this. These are the similar lines that we have done over here. The only difference is that we are starting from the transition phase. We are starting from the transition phase. Okay, fine. So Guram is getting what? 1072. So there may be some rounding up error. That's okay. Small rounding up error is possible because we've anyways taken present value factors and a lot of cash flows are rounded up. Okay. So there's going to be quite a difference in that case. So no worries about that. So so just try out this question 31, as I said. It's similar to the Hiller H model or the transition phase model that we have. If you have any queries, then we can take it up now, guys. Any queries, guys? Do you have any queries in regards to today's session or any previous session? No? No queries? Perfect. Okay. You don't have any queries? Okay. Okay, fine, guys.
Okay.
Just do these two questions which I've given you as homework, okay? Yes, sir. Rashi, sir, please go ahead.
Thank you, Jackbandhu sir, because your session was started with the concept of the fair value, or we can say intrinsic value of the security. Now, student, in the previous chapter, that is topic of security analysis, we have discussed the topic of fundamental analysis and technical analysis in a great detail. Now, when we talk about the fundamental analysis, it has started with the economic analysis, then it has come to industry analysis, then it has come to company analysis. After identifying the company, of course, the fundamental analyst or the equity researcher normally find out how much value we should pay for the share, because it is always seen that sometimes the value of a share, or the intrinsic or the fair value of a share, that maybe not we can say the worth that much, that is at which it is trading or it is quoted in the market. So that's why this security valuation has its very greater importance. And another aspect of the security valuation is very important in the sense that, because it is also linked to the chapter number 14, or we can say chapter number 13, business valuation, and even for the chapter number 14, merger acquisition and corporate restructuring, where in the process of merger acquisition, the shares are generally swapped. Okay, so when shares are generally swapped, it is generally on the based on the fair value, or even on the basis of intrinsic value. Of course, market value is also the criteria, but sometimes this value, intrinsic value also possesses we can say importance as well. Now, when we talk about the how we measure the fair value, it is basically the cash inflow stream, and because it is based on our capital busting decision, that today I am investing this much of amount, I want to get this much of amount back from the securities. Now, but there is one point when Jagvantu sir was teaching, if the company is not repaying, or we can say the company is not declaring any dividend, despite the company have a profit. Now, student, here the topic we have covered in our chapter number 1, that is sustainable growth rate, now comes into the picture, where external funding requirement we have studied, where a company retaining a portion of its profit, and even sometime they are retaining 100% of its profit to plow back, so that they can achieve a sustained growth rate or any particular growth rate. So we can understand that all the chapters, if we see that they are interlinked to some extent. Similarly, when the company is not declaring any dividend, so what should be the benchmark to value this type of a company? Of course, we shall see the free cash flow there, because it is one of the important criteria, that how much free cash flow belong to the equity. It is one of the very important criteria that of course, because this ultimately belongs to the equity shareholder. Only thing is that it is plowing back. So, sir, you will continue this topic in the next class as well?
Yes.
Okay. So, student, sir has given you the 2 questions for the homework. I hope you will try the same, and whatever your queries you will discuss in the next class. Student, thank you for patiently listening. And student, as a custom, Jagvantu sir, just show our display our 01203045 956. Okay, this is our contact number. And our email ID sfm-final@ICAI.in. So, student, if you have any query, you can still free to ask at this number, contact me, or you can also send the email at this number. Thank you, Jagbandu sir, for sparing your precious time and letting the student on this topic. Thank you very much, and have a nice day.
Thank you.
Thank you. Okay, Sanket ji, end the session.